basically today, and what we're going to look at doing over the next probably month, is just go through a few different key topics when it comes to insolvency, and just explore some of what some of the myth busting might be in relation to personal and corporate insolvency, which will be in a couple of weeks' time. We'll look at some voidable transaction defense type issues and how you might overcome anything to do with a demand letter from a liquidator and what that might look like. So we'll probably do that in about a month's time. Hi, Cindy. And then in about, so those will be your two topics for the next, month or so. But in terms of today, what I really want to talk about is all things to do with solvency reports. It's a area that's very much passionate about. I do a lot of expert solvency reports here at SV Partners, particularly for other liquidators from external firms, and also for defendants to proceedings and that. And so what I wanted to do today was talk a little bit about the tips and tricks when it comes to solvency reports, but I guess flesh out a little bit about what they are, what they're made up of, and just try to make it a little bit easier for people to understand, especially as I do talk about them quite a bit on LinkedIn and that. Hi Daniel, how are you? Basically when it comes to solvency reports, I don't want you to think of them just in terms of an expert report that has to go to court. That is the general concept. They're predominantly prepared by liquidators when they're wanting to pursue creditors or related parties for some type of scrupulous transaction. But it doesn't have to be just that. There are so many other opportunities that you can use them for. And I think probably if I can just go through a few of those with you today, think about a statutory demand. So if you're receiving a statutory demand from someone in the mail or supposedly now potentially by email, you only have a very finite amount of time to deal with that statutory demand and try to hopefully get it set aside. And one of the grounds that you can do that, especially when it comes to a winding up notice, is to prove that you're solvent. So a solvency report is very important in that area, but it is very different to one that you would file in court for a voidable transaction or something like that. So we'll explore that in a little bit more detail shortly when it comes to what does solvency really mean, and we'll look at that shortly. But when we're talking about other types of solvency reports that you could use, I think I've had a few over my career where we've used them for negotiation purposes. So you might be negotiating with a creditor or a landlord or a bank or the ATO or someone like that, and a large part of what hi Andrew, a large part of what you'll be doing there is you want to prove that you have the financial capacity and means to deal with whatever restructuring option or whatever debt negotiation you want to deal with. So they can be really important in that area, and it's not going to be a fully fleshed out solvency report. It's likely to just be something quite small and minor, and something you could get done for quite a cheap and flexible price. So there's a couple of examples. I think one of the ones that is really overlooked is the idea of a critique report. Okay, so a lot of the reports that are filed in court are ones where you're preparing a full-blown expert report to go into court, and it's either prepared for the liquidator or for the defendant, and it's proving solvency or that it's insolvent. But a critique report is one where you're looking at the other side's expert report, or even your own side's expert report, and picking it apart, so to speak. So the general gist of it is that you look at what is being prepared, and then you work out whether or not you think there's issues within it, things that you could attack on, and they're nowhere near as expensive as the full-blown report, because what you're really doing is you're looking for opportunities to say, well, hang on, no, that's the way that's being set out and what's being put there is just fundamentally wrong. And that's very much what we'll be looking at, talking about here, is is what are some of those tips and tricks, and what could I guess a critique report look like, and I'll go through that shortly. But what I didn't want was people to think, oh no, it's just these big long reports that liquidators tend to prepare, and that there's so many other opportunities there. And what I would suggest you do is, if you go to my LinkedIn page, about a month or two ago, I put up a slide of all the different avenues that you could use a solvency report. So if you just search hashtag SV Voidables on LinkedIn, you'll see it there, and there's heaps of other opportunities to use them. So when I talk about a solvency report or insolvency report, I guess the concept here is that we're proving the company's insolvent, okay? So, hi Jason. So what we're trying to do is we're trying to determine, is the company insolvent or solvent at different points in time, okay? So what is the test of insolvency? You'll find that, particularly when it comes to corporate insolvency, will be found in the Corporations Act, and it talks about when is a debt due and payable. Now, case law has taken that phrasing to say, well, the way you've got to assess that is by way of reference to the balance sheet test, by reference to the cash flow test. Okay, now, so many people, when I talk about this stuff with them, they immediately jump to the cash flow test, and it tends to be this sense of how much available cash does a company have right now to pay all of its due and payable debts. Now, that test is just wrong. And I'll unpack that a little bit in a second, but the cash flow test is always referred to by courts as, yes, that is the fundamental test, but it's not as basic as what that prior sentence is made out to be. There's a little bit more to it. So you got to not only deal with that, you also need to deal with the balance sheet test, right? So the balance sheet test, to me, is the building blocks of how you then build a cash flow test. So the balance sheet test, it's as the name suggests, you look at the balance sheet and you look to see, from a non-going concern basis, what are the assets that are readily realizable, and what are the liabilities that are due and payable. When you're looking at that, a lot of that information you're going to get from management accounts, from external financials prepared by accountants, etc. And you're going to take all that data and you're going to adjust it. You're going to play around with the numbers based on different accounting standards, because I've never seen 100% correct set of financials, and that's what we're doing here is adjusting them so that they are as best as you possibly can get them to be correct. And I said a very important phrase just before, a non-going concern basis. Most financials that you are given in your day-to-day lives as business owners and accountants is you're preparing financials on a going concern basis. That is not the test here. It is a non-going concern basis. So you're going through the assets, you're looking for realizability. Once you look at all that realizability, you then test that compared to creditors, and you work through those numbers. Okay, so that's the balance sheet test, and that gives you the foundation for what becomes the cash flow test. Now, the part of the problem with the balance sheet test is that it only really looks at the available assets now. And that was that sentence I was talking about before, where a lot of people, and I see it a lot at the moment from other liquidators and other experts out there, they tend to use really outdated precedents. And some of those precedents refer to this idea of cash assets now, and whether or not those cash assets now could be used to pay due and payable debts now and into the future. So that happens all the time. It's not the correct test. You need to look at also the available assets. And the available assets is a really key area where you're not just looking at physical assets sitting in the bank account or stock of trade or inventory or real property or anything like that. You're dealing with more than that. You're looking at potential funding opportunities from related parties, from trying to source equity from a bank or loans from a bank or equity from other investors. you're looking at all these different things around the definition of due and payable, and I'll come to that soon. But this idea of just funds in the bank as the test is just not right, and that tends to be why some people tend to try to do these cash flow reports, and they prepare these cash flow reports based on money coming in, money going out, and they say as a result of those numbers, that's how you create a cash flow test, and it's really not the correct way. So that would be one of my biggest tips and tricks for people, is to really test this idea of what really does a cash flow mean, and when you look at alternative financing and getting and securing money from a related party, that's a really key area where you can, if you're doing a critique report or something like that, where you can, I guess, attack the other side or attack the other expert. When I talk about getting access from other funding, I hear it all the time. You say, oh, look, I understand the company's insolvent now, but I could just go and get the director to put in $100,000 or whatever to pay down creditor debts, whenever they needed. It's really not as simple as that. I think that there's a few different things that you need to look at there, and I think you need to say whether or not they did. So that's probably the first key test. So did a related party or a director pay money to the company to get it past any short-term financial issues? So most of the time the answer to that would probably be no, otherwise you're probably not doing a full-blown report. So if that is a no, then the second test, I think, is could they have? Okay, so could they have? Really there, I think there's a couple of further requirements for you to consider. So could the director have provided more funds? Well, what do I want to see there? I want to see a positive obligation for them to. That positive obligation is more in the form of some type of agreement or some type of funding agreement that has been entered into, where the director or someone will promise to give funds whenever the company really needs it. But that's going to be quite rare. I don't really see a lot of written funding agreements or anything like that. The second part, I think, is probably more where you're gonna find it's going to impact on a lot more people. So the second part of that to me is at a time of when you're doing that test, is there a positive willingness or something like that? Sorry, I've just got a question from someone. So I just got a question from Andrew. Are you seeing a rise in the number of requests for solvency reports? Also, types of reports. Also, what types of reports do you do? So I think in terms of the question around build up in solvency reports and that, definitely seeing a lot at the moment. We're probably doing the most we've ever done at a point in time. I think a lot of that's been driven because a lot of people from last year were not being as litigious or anything, and now all of a sudden that's definitely picked up a lot. We're seeing a big increase in the number of I think that pretty well answers your question. So when I'm talking about this positive willingness concept, what I want you to consider is just because a director says that they will give the funds whenever they want, that's really not going to get you there. You're going to need to show an historical willingness, so that there had been times in the past where the director has at least put in some funds, and then also a capacity. So you're going to have to go through and test whether or not the director has the capacity or the related party has capacity to put in the funds, and that can be quite an invasive process. As you can imagine, you don't really want to personally have to give up all of your asset and liability position to a room full of experts and lawyers, etc. So, I think if you're going to rely on that, you're going to want to really think that through, because you're going to have a lot of people looking at that information. So there's a couple of little tricks in there when it comes to the cash flow test. And really today is about going through some of these tips and tricks and just explaining a little bit more about solvency reports. I really only envision this going for about half an hour or so I see I've got about 15 minutes to go, but if there's any other questions, I'll certainly try to answer them. But when you're looking at doing these types of reports and that, I think there's some things that I just wanted to sort of talk about in terms of these tips and tricks. I think one of the ones is to really consider how to make the expert's life a little bit easier, because that's what's going to drive fixed fee arrangements and trying to control the budgets and stuff like that, because these types of reports can really blow out, especially with so much information being given. So what I would always suggest to people, if you're considering briefing anyone on when it comes to expert solvency reports, give them a call first, ask them what they need in terms of the information, and whenever you give them information, try to give as much of it as you possibly can by way of Excel. Excel documents and all that type of stuff just make our lives so much easier, and will make the clients a lot happier, because then you're not having to spend so much time doing double entries of stuff and that. A few other things I'd suggest is making sure that you give full access to the management accounts. Don't just rely on PDFs and Excel. And probably the biggest one of all is to make sure you give the general ledger report. If you don't know what that is, I wrote a post on it just the other day on LinkedIn, it's certainly a report that you can extract from the management accounts. But go check out that post. It's under hashtag #SVBoardables, and you'll see it there. Some other tips and tricks, I think what I would suggest is when you're critiquing or you're looking at a liquidator's solvency report, so say you're a lawyer or you're advising a client on whether or not they should challenge such a report, there are a couple things that I think a lot of people don't realize when you're looking at these reports, and I just wanted to go through a few of those now. So one of them would be this idea of the age payables report. So it tends to go into every single solvency report I think I've ever seen. And so what the age payables report does is it looks at all of your trade creditors and then compares over a period of time whether or not the company was meeting its creditor debts as and when they fall due. And those that creditor analysis is actually just quite easily extracted from, say, MyOb or QuickBooks or Reckon or something like that. It can be quite easily downloaded from it. It'll come out in an Excel format for the liquidator, and so then the liquidator goes and slaps that straight into their report. Now, part of the problem with that is two things. One is you're relying on the card files being correct in terms of credit terms. And secondly, MyOb in particular and some of the other programs default to an aging which is from the date that the invoice is put in. Okay, so if you're the liquidator, you're going to want to rely on that because it's better for you, really. All of the aging numbers, because you've got to think about it in terms of the higher that aging, the worse it looks. It looks like the company's not paying its debts when it falls due. And it populates all the time out of the software as based on the date the invoice came out. So you actually need to sit there and click particular buttons on the program to extract the correct information out of it. And it never happens. So we're very particular on making sure that if we're doing any critique stuff, we've got full access to, or any defense reports to be fair, we've got full access to the accounting software so that we can actually do the extraction ourselves for these types of reports. And there's a few others that are like that, where people don't really want to share that because it is a bit of a something that people just don't pick up on. So just be careful with that. A couple of the other ones, I guess, are this idea of like looking at the industry. So if you've got a construction industry or something that's like really WIP laden, something where like even a professional services firm or something like that, people tend to forget, especially when they're doing their accounts and stuff, to put in an actual WIP figure. They generally leave it as like a general journal entry at the end of each financial year, or that's what their accountant puts in, etc. And there tends to be very little paperwork as to how that number is calculated in that, or if at all. Like, it may just be that there's nothing put in for it, so it undersells the value of the balance sheet. I think if you look at the type of industry that you're dealing with here, it's really critical to think about what other accounts, not just what's in the balance sheet, not what's just in the financial accounts, what other accounts could actually make up this company. So I'm thinking goodwill, I'm thinking WIP, IP, potentially crypto related stuff. So all these things that don't necessarily get added into the balance sheet, that could play around with your numbers on a solvency report. So I think it's just really important to think about the type of industry you're in, and make sure that your expert that you've engaged has as much access to stuff as you possibly can get. But at the same time, you don't want for them to spend too much time on stuff. So you want to give as much as you can via Excel to make their lives easier. But at the same time, you do want to give them access. So just be careful in those areas. Just looking at a couple other things. A couple of other little areas that have come up lately that I did want to talk about. So when a liquidator pursues creditors or related parties or whatever for avoidable transaction, the liquidator has a right to a presumption of insolvency in certain circumstances. Okay, so that presumption can arise when a company has breached its books and records requirement. Okay, and for a long time, that books and record requirement seemed to be quite difficult to breach. A lot of what we thought was it had to be something really out there where someone had just, hadn't done any financial accounts, were way behind on all their tax returns. Their bank statements are almost impossible to reconcile, all that stuff. Now that's been thrown into doubt lately. There's a case that got handed down, I think it was the end of last year, called Adelaide Brighton Cement. And so what that case looked at was if you miss a material liability, I should say, and I guess actually in theory it would apply also to an asset. If you miss a material liability, then you could be found in breach of that books and records requirement. Now that's quite extraordinary, because in this case, all it was just one liability. It was a liability for a couple of $1 million, which I think made up about 10% of all the liabilities there was. And we see it all the time. We see regularly there is a dispute about a debt, and so the company is not putting any contingent liabilities or any contingency against that debt in their financial accounts. And in theory, the way that my screen went blank for a second. Basically, a lot of the time these people aren't doing these contingent liability assessments or anything like that. So you could potentially be in breach of the 286 provision. And the court talked about this idea of it not being de minimis. Okay, so effectively all that means is as long as it's material and as long as it's a significant amount, a liquidator or someone on the plaintiff's side could quite easily point to that being the case, that you are in breach of your books and records requirement. Now, the presumption doesn't apply in all circumstances, even if you have breached your books and records, but it's still an indicator of insolvency under the ASIC implement test, which is a case that deals very much with this concept of a cash flow test. And what it does is it gives you a whole bunch of indicia of what you could look at if you're concerned or considering whether or not a company's insolvent. So what this 286 could do is elevate this issue as potentially an indicator of insolvency. So, and it's quite an easy one for the liquidator to just tick off. So very important that that case is considered quite closely. And then the other case that I just wanted to quickly touch on, because I can see the time, is the idea of ATO payment plans. ATO payment plans forever have always been looked at as the ATO giving you time and availability to meet your ongoing tax obligations. It happens all the time. People can't pay their tax debts, so they enter into a payment plan. The ATO seems to be pretty flexible with them, especially at the moment, and those can extend for 2, 3, whatever years. For a long time, what we all thought was those payment plans meant that a debt could not possibly be due and payable. Okay, so because you're under an arrangement, right? You've agreed with the ATO that your debt to them is not going to be due and payable for, say, 2 years. Let's go with that. 2 years where it's not going to be due and payable. What has actually now happened as of 2019 is that there's a full federal court decision. It's called the Solar Shock case, and basically it's a case that went firstly to the federal court, then up to the full federal. And so what they decided in that case, there was 2 key things that they decided, but one really only being relevant for now. But what they decided was that the ATO payment plan did not extend the period. So if you think about all the trade creditor arrangements and where trade creditors give you time to pay off your debts and that does not apply to this case. This is just relating to the ATO. And what they found was that when the ATO gives you a payment plan, it's not done because of the goodness of their heart or anything like that. It's done because of a statutory allowance, let's call it that for the time being, the statutory allowance within the legislation that gives them the discretion, I guess, to grant you an arrangement. And what someone did was they found some obscure provision somewhere in the Tax Act, and if anyone's seen the the various tax acts, they're absolutely enormous. So someone found this obscure provision somewhere in there that basically said that even if you enter into an arrangement, you are not extending the payment date. So notwithstanding, even if you've got a payment arrangement, the debt is immediately due and payable. Okay, so arguably, if you have a due and payable debt with the ATO, notwithstanding, and you can't meet that due and payable debt now from your financials, then arguably you're immediately insolvent. And so it was quite an extraordinary decision, and the ATO was not a party to that case, so I do want to stress that. And I've spoken to the ATO a number of times since about it, and they're adamant that it's wrong. But I would again say it's the full federal court. You're talking, one court short of the High Court. So it's certainly something to add into your arsenal that if you enter into a payment plan, you need to be very careful that you're not breaching the insolvency legislation around the insolvency provision, around whether or not you're insolvent, because arguably if you enter into that arrangement and you do not have the available assets, then or readily available assets, then you could potentially be insolvent. So it's certainly an important thing to consider. Just having a quick look at my notes to see if there was anything else that I wanted to quickly raise. No, I don't think so. As I said at the start, I really just wanted to spend half an hour or so with everyone. There's quite a few other things I could probably talk about it, I guess, in terms of insolvency reports. I could certainly talk about a couple of war stories in that. But if anyone wants to leave any last minute questions or anything, I'm happy to keep talking for a few more minutes. I guess one thing I would just quickly say with solvency reports is, make sure that you choose the right experts, that you're reaching out to that you're reaching out to solvency firms or insolvency firms who do this. It's really a very niche and specialized area. There's a lot of talk about whether liquidators can prepare their own reports. I have my own particular view on that, which is that if they're unfunded, they don't have any money in the bank account or whatnot, they shouldn't. But that's certainly something that's my own personal view. That's not the view of the firm or anything like that. I think it's really important that when it comes to these insolvency reports, you talk to the right people and you find out whether or not what the cost is going to be up front, because that's really important. These can very easily blow out if the right scope is not put into place, that the right planning is not done, that the right information is not provided. So really got to be careful and don't just think about the big expert report. Think about potentially getting someone to do a critique, and that critique could be informal. It could just be by way of email or by verbal. All in the aim of picking something apart but trying to keep it relatively cheap. It could be for a negotiation. It could be for all these different avenues. It doesn't have to be this big, fully fleshed out report that so very few people firstly are able to prepare and secondly have ever seen one before. So it can be used for so many other things, and certainly implore to reach out to me to have a chat more about them. I certainly enjoy doing them. So more than happy to have a chat to anyone. If anyone's got any last minute questions, I've just allow everyone to go and have their lunch break and enjoy a Tuesday. Otherwise, I will let everyone go. And thank you very much. I think what we'll probably do is in about 2 Tuesdays' time, I will likely do another one of these, but it'll be on myth busting insolvency, looking at different things around corporate and personal insolvency, talking about some things where people just have the wrong idea of what goes on and what happens to, say, your house or your super if you go bankrupt, or all that type of stuff. Thanks, Kyle. I would we'll go through all these different things from a myth busting point of view, and we could talk about that a lot in a couple of weeks' time. Thank you very much, everyone, for joining me today.